Hello, welcome to an education video by Integrity Capital on how to analyze a business's profit and loss statements for cash flow. Now, whenever you receive a client's profit and loss statement, you're going to look at it on an annualized basis, generally speaking. There are going to be times for the interim period, which would be sometimes referred to as year to date, where you might get a certain period of time. This could be from January to June, it could be the first or second quarter, whatever that period of time is. What you want to make sure of, if this client or company has multiple companies, then you want to make sure that it's consistent in the time periods all the way through their company. So for example, let's say XYZ company has January through March 2017, then you'd want to make sure the next company they have is January through March. If they have another company, January through March, and so on and so forth. It just helps keep things consistent throughout as you're trying to analyze the financial numbers. So the very first thing you're going to do is collect the profit and loss statement and or tax returns, and you're going to begin to put the years up top here. The actual very first thing is you're going to put the name of the company up here in the corner. Then you'll scroll over and you will put in the period of time for that year-to-date period. So again, if it's all of 16, that's great. If it's just for certain periods of time, then you'll put that in here as well, so you understand what period of time you are looking at. Next, you'll put the year prior to that, the year prior to that, and then the year prior to that. So, for example, if let's say it's January through June of 16, 2015, 2014, 2013, and that'll give you some sense on how to start off. Once you do that, then you will begin to go into each one of these fields and collect the appropriate information for the net income. Many times you might look on the profit and loss statement and see operating income or something to that extent, but make sure that it is something equivalent to whatever the net income after all the expenses are in place and prior to any other elements. So you put the net income in each one of these fields for each given year. The next thing you'll do is you're going to put in the interest. So there should be a line item on there that says interest or interest expense or mortgage interest expense, something that has to do with those items. You will put that in this field here. And then the third thing is adding back the rent. Now, one of the things to note is the only time we're going to add back rent is if an owner-occupied client who has been renting for the last period of time, several years or so, they are going to replace that rent with a brand new building, then you will add the rent back because it's no longer going to be applicable. This is called a rent replacement. So you want to make sure you collect that from the client and make sure that you add it back in. Otherwise, you're not going to input that in here as well. Sometimes they might have multiple locations, so it's important for you to find out, are they just replacing one location, two locations, so on and so forth. Third thing is to add back the depreciation and amortization. And you say, well, what's that? Well, depreciation and amortization are nothing more than non-cash expenses. So if I buy a property, the government allows me to put it on a certain schedule over a 29 or 30-year period. I divide that over that period of time for the cost basis, and each year I get to deduct off of my expenses this depreciation amount. So you'll see that on the tax return or the profit and loss statement. It will say depreciation and or amortization, and you want to input that information in the field across here. Finally, at the bottom here, you'll see living expenses. So most of the times, most of the time, lenders are going to want to deduct living expenses out of this particular profit and loss. So what you'll do is you will use a standard formula, which is something to the tune of could be $10,000 to $15,000 per individual per household. So if they have 3 kids, you'll multiply that amount by the amount of people in the household. Once you scroll your mouse over this item, you'll see a pop-up for the formula, and you can just abide by that. Once you put all those in, you're going to get all these totals at the bottom. And what we usually look at this as is a EBITDAR or an EBITDA, so earnings before interest, taxes, depreciation, and amortization. And on each one of these locations, or companies I should say, it's going to have its own EBITDA. Once you have input every company, if there's multiple, at the very bottom it's going to total this number by summing up every single one of those locations. The reason why this is important because it gives us an idea on what they look like on a global basis to service their debts and the new debts that they are going to take upon the company as well. So again, this is education for inputting a profit and loss statement into our analysis model. This is Dave Cotter, Integrity Capital, and God bless.